good afternoon, ladies and gentlemen, and welcome to our next webinar in the Admiral Markets Trading Spotlight webinar series. And today we're going to be talking about how to trade using the MACD indicator. My name is Paul Wallace, and here on behalf of myself and everyone at Admiral Markets, we hope that you're all keeping safe and well during these rather turbulent times, and that it's fantastic to have you joining us here today to help learn more about the wonderful world of trading and what it actually offers you, and the various opportunities are out there. As I said, we hope you're all safe and well, and if you stay with us throughout this session, hopefully we'll have time to have a little look at live markets and live opportunities as we go through our session. If you already are aware of what the MACD, or if you've had experience of trading with using the MACD, then please just give us a little comment. Let us know what your own thoughts were from your own trading experiences, or if you're completely new to trading, then just let me know here, and we'll be able to make sure that we're sort of pitching our topics here at the absolute right level. If you're watching this later on demand on YouTube, then please, if you found it useful, give us a like. If you've got questions, put them in, or if you've got thoughts about possible new sessions as well, or ideas, that things you'd like to sort of us to cover, then please do drop us a note. We really enjoy the interaction. So what are we going to talk about today? We're going to talk about, well, actually, what is MACD, okay? What is the wonderful world of MACD? And I'm going to talk a little bit about, well, how do most people trade using the MACD indicator? And what we'll do is help you think about, is there a smarter way to trade using the MACD? Is there a way you can use it that would help set you apart from really the people just sort of trading it the sort of textbook way? And then, as I said, based on our timings, is that as we'll look at the MACD on popular markets. And as I said, if you've got questions or thoughts or ideas on the MACD itself, please just put them in the chat box. We always really appreciate the interaction. As always, I realize we have a broad range of experience who join us for our sessions, okay, from people who are complete beginners to very experienced traders, but we all enjoy the interaction. It's fantastic, makes for a fantastic session for us all. So for those who don't know me, my name's Paul Wallace. I'm a sort of a trader and coach, and have been for many years. Okay, so primarily I like to sort of trade trends for my swing and position trades, and I'm a mean reversion trader for the intraday trading. That's the way I particularly look to work. And we also here, Admiral Markets, okay, they're a global brokerage with effectively who are licensed and regulated across a range of regulatory environments across the world, providing competitive spreads on the most popular trading products, and offering you the ability to engage with markets using the MT4 and MT5 platform. If you have any questions about Admiral Markets, please get in touch with your account representative, and they'll be very happy to help guide you. So here we go, how to trade using the MACD indicator. As it says there, the MACD is a popular indicator, but not everybody uses it properly. Not everyone understands how to use it to boost their trading endeavors, because there are many ways for traders to use it to both analyze markets and provide entry triggers. And in this session, we'll discuss how to use the MACD and how to engage markets using this popular indicator. So as I said, some people will have had experience of it there, okay? So, see Robert's there, okay, says, I've used it on my longer trades. It works quite well, and that's excellent. And I'll be interested to see how, Robert uses it in his own trading decisions. And I'll be interested to see whether that links up with how, I'm going to sort of share with you the kind of various ways you can do so in your own trading here. There's as with all trading, okay, there as the saying goes, there are many ways to skin a cat, okay? And it's the same with trading, especially when you're using indicators. There are nuanced ways within which you can utilize indicators to help you make trading decisions. We'll discuss and cover quite a few of them here today, and hopefully that will provide you with a bit of insight into how how you could utilize this indicator yourself. So, how to trade using the MACD. So, what is trading currencies with MACD? And firstly, well, for those, as I said, who are completely new to trading, what is the MACD? And as it's kind of named as it's pronounced, the Moving Average Convergence Divergence, MACD. Okay, it's an indicator created back in the 1970s by a chap called Gerald Apple, and he wrote a book on it. Okay, as you can read there, the Moving Average Convergence Divergence trading method. Okay, if you wish to read more about this particular indicator. So the indicator has been around for a good time. It's well known. You'll find that most trading platforms will have the MACD indicator available to traders on there, and it has to be honest, it has a bit of a mixed press. Okay, and the reason I say that is because, as I said a few slides before, is that people's interpretation of it can be their biggest hindrance. There are several ways to actually look at and understand it. Okay, and hopefully we're going to share a few of those with you today, and you'll be able to be a little bit wiser in terms of how you could utilize it in your own trading endeavors. And that's what we're always looking for here today, is to give you new insight, new information, new knowledge that you can help build into your own trading plan, into your own trading business, and by doing so here, these sessions will help just give you a little bit of a help, okay, a little bit of a sort of a guidance on your own trading journey. So as we talk about MACD, it would help, as I say, for some people to understand, well, what is the MACD? Okay, we know it's the Moving Average Convergence Divergence. Okay, but what does that actually mean? That's a lot of just a lot of long words. How does that actually help us as traders to do it? Well, what I can say, okay, is from a bit of experience, is MACD tends to work best in trending environments rather than range-bound environments when you're looking at it in its most original sort of specification, and it can be used to help signal the start of a possible new trend or the end of an existing one. Okay, and that's a topic we'll come on to a little bit later. Okay, it's a quite a simple indicator, but once you start to learn to understand how it's created and built, well, then you're in a position to sort of as I say, use it in variations to help you with your own particular trading decisions. So what I'm going to talk about is a traditional MACD. Okay, so when you use a traditional MACD here, let's use our drawing tools here to help us, is that we see a combination of two different types of indicator. So the first, MACD employs two moving averages of varying lengths to identify the trend and the direction. So on a traditional MACD, you will see something like this. Okay, like here we have two moving averages. Okay, and secondly, it takes the difference between those two moving averages and plots that as a histogram, and this can be used to identify momentum. So it takes the difference between, here you go, between our two moving averages, okay, the actual distance between them, and then it will plot that, okay, as the histogram. That's what you'll be seeing, okay, on your chart. So when you look at a MACD, that's what it's actually made up of. And we'll go into that in a little bit more depth. But as I said, I appreciate there are people here who are new to trading and may not fully understand what MACD is, and we want to be able to help educate them on that. So two moving averages, okay, and the histogram, which reflects this kind of difference between those two moving averages. So as they're very close, let's say here, okay, you can see that the histogram, okay, is actually quite small because the difference is very little, as opposed to where there is a greater difference between it, that will reflect upon the histogram as well. So also with a traditional MACD, you will get to see three numbers. Here we go. That's these numbers here, right? The first is the number of periods that is used to calculate the faster moving average, which is known as the MACD line. Okay, in this particular example, that would be the blue moving average. Okay, it's the faster one, it's the MACD line. The second is the number of periods that is used in the slower moving average. Okay, so here we go. In this one, we've got the MACD line, okay, is 12. The slower moving average is 26, okay, which is the signal line. And the third number is the number of bars that is used to calculate the moving average of the difference between the faster and slower moving averages. Okay, that's the number of bars that is used to calculate the moving average, okay, of the difference between the faster and slower moving averages, which is reflected as the histogram on your charts. Okay, so you'll see there 12, 26, and 9, and you'll find that most sort of MACD indicators, most trading platforms, they will utilize that as the standard setting, 12, 26, and 9. So to say you couldn't sort of amend that, and I know traders who do amend it, but today we're just, as an introduction, we're just going to talk about really the kind of bog standard, what you can actually switch on when you open up your MetaTrader 4 or MetaTrader 5, and what the actual indicator will provide you, and what the kind of numbers you'll see in terms of the setting. So 12, 26, and 9 are normally seen as quite, as I say, quite sort of standard settings for the MACD. So as I said there, 12, 26, 9. The 12 represents the previous 12 bars of the faster moving average. The 26 represents the previous 26 bars of the slower moving average, and the 9 represents the previous 9 bars of the difference between the two moving averages. And this is plotted by vertical lines called the histogram, and that's the green lines of the chart that you can see on that particular chart here. Okay, that's what we're looking at working with here. And that is what we would see on, as I say, a traditional MACD, which will become clear to you in a few slides' time. So there is a common misconception when it comes to the lines on the MACD, okay? The two lines that are drawn are not moving averages of the price. That's very important to remember, okay? Two lines, okay, are not moving averages taken from the price. Instead, they are the moving averages of the difference between two moving averages, okay, which might sound, might sound a little bit confusing to new traders, but you just want to make sure that you're aware of that, okay? It's not taking it, those kind of 12 and 26 is not a moving average of price, okay? Instead, they're moving averages of the difference between the two moving averages, and that becomes much important in terms of how we see the MACD get displayed upon our charts. So more importantly, as we move towards it, now we can understand, well, where the numbers come from, how it's created. It's, well, how do we use that data to analyze markets? Well, invariably what we see in traditional MACD is when the MACD is positive and the histogram value is increasing, then upside momentum is increasing in the markets. And on the flip side, when MACD is negative and the histogram value is decreasing, well, then downside momentum is increasing. So here, if we just, as I said, if we just draw this tool here, okay. So, we have here, we can see that basically the moving averages, okay, the 12 and 26 moving averages are, they are negative, okay, because they're negative beneath this 0 line here that you'll see when we look on the main charts, and also the histogram value is decreasing as well, and that is what then tells you that downside momentum is increasing. That's showing that, you'll normally see that reflected in price, and we'll put it all together in a few slides time. And equally, okay, when the sort of the MACD, okay, the MACD is positive and the histogram value is increasing also, well, then that's giving an indication that momentum in price is likely to be increasing also, okay? And that becomes, as I said, becomes quite clear, quite a simple way to analyze markets, okay? And lots of houses, lots of institutions will still use that as a way and means of kind of making decisions. But what you'll find is, as I said, things will move on, and as we go through more of the slides, we'll have a bit better understanding of kind of what these kind of elements contain, and actually how the interaction between them can help us more when we look to make our trading decisions. So how do we use it? How do we use it to trade using the MACD? Okay, well, the first one, or the first simple one, is when we see signal line crossovers. All right, that's the most simplest use of the MACD tool. Okay, the signal line is calculating the moving average of the MACD line, so it is always lagging. Let's just get our tools on here. Okay, so the sort of the signal line, as I say, is always lagging. Okay, this is our second one here. Okay, remember the signal line is essentially an indicator of an indicator. That's why it's lagging. So cross of the MACD line above or below the signal line can potentially signify a strong possible move in the actual underlying instrument. So when we see a cross like here, I'm just going to draw this in. As I always say, please excuse my drawing skills. Okay, I'm a better trader than I am an artist. But when we see the kind of the MACD line, okay, crossing, okay, the signal line, well, that could be an indication that invariably, if we were to look up at the actual price chart, that the price would actually be beginning to rise. So that is actually the most simplest use of the tool. And as I said, there are people who will use this tool quite happily, quite successfully, okay, consistently, just by merely sort of looking to trade signal line crossovers, okay. And you know, you'll find if you want to look into that in greater detail, you'll find that there are university studies on technical analysis, which basically have just been based around the researchers just effectively looking at how price would have traded using simply nothing more than signal line crossovers on the MACD. And here's an example here. Let's just use the drawing tool. You can see that price has been in a pretty strong downtrend. This is a weekly chart. You can see that that actually the MACD is below the zero line. Okay, below the zero line, as is the histogram. Okay, it's below the line. But then what we see is, we actually see is that by this point here, where the arrow is that actually we've had an indication that the faster MACD line, okay, has crossed the slower lagging signal line, and then invariably some people will have used that as an opportunity to to buy the market there, buy that particular market around that particular, probably around that area. And then as you can see, it goes sideways a little bit, but actually ultimately it makes its way up. Price moves further north. Okay, so just a simple using the kind, as I say, as a MACD kind of signal line crossover as a very, very simple way that you could choose to use in terms of making your trading decisions. And here on the opposite side, okay, on the bearish side, this is a short intraday, okay, and we see the dollar against the Swiss franc has been rising, and then until we actually see here that the MACD line crosses the signal line to the downside, okay, and also we see that the histogram as well is coming, and actually what you see is that price then moves down for the that will be the next couple of hours on a 15-minute chart, okay. So as I said, it's people can use that there, and even just looking at this chart, you can see here, okay, that invariably when here the MACD line crossed the signal line to the upside, that's when we saw price actually rally its way up as well. So a very simple way to use the kind of for the MACD, okay, is, as I said, just using bullish or bearish signal line crossovers, and there are lots of people who can trade. And if you're very new to trading, that might be an easy way for you to begin using the MACD, okay, regardless of what time frame. You can just open charts on different time frames and have a look and sort of identify where and how the signal line crossovers occur and how you can utilize that in your own particular trading. Then next, as I said, I'm going to share with you quite a few different ways that people use the MACD, and you can take them away and sort of start to have a look at how you could build that into your own trading style. And number two there, okay, in terms of ways to trade, is actually trading what they would call zero line crossovers, okay? So there's a similar premise to the signal line crossover, and what happens is it occurs when the MACD line, okay, which is in this case is the blue, is the faster line, crosses the zero line, okay, and it becomes positive when it's above zero and negative when it's below zero, okay. So invariably that's a case of, when we see here, let's just once again, as I said, excuse my artistry, when we see the MACD line, okay, crossing this the zero on the histogram, okay, then we'd be looking to be positive, we'd be looking to be bullish, or alternatively, when we see it here, when we see the MACD line crossing beneath zero, okay, that is actually when we are going to be bearish. It'll give us a bearish bias in our trading decisions. So that's the way we'd be looking to do that. Takes just a little bit more, perhaps a little bit more nuance, perhaps not as necessarily always as clear cut as a good strong signal line crossover, but it allows you to, what it do is to get an idea of where perhaps the sentiment, okay, whether you're going to have a bullish bias or a bearish bias for the next couple of hours of that particular session that you're trading. And one of the things about MACD is you'll find it's used across all instruments, okay, whether you're trading monthly charts on euro dollar or 5-minute charts on gold, okay, or you're looking to trade 4-hour swings on copper, okay, you'll find that there is MACD is used across all sort of time frames and all instruments for trading purposes. So here we go. Let's just draw in a tool. So we looked at this chart just before, okay, and we can see firstly this is when the signal line crossover occurred, okay, we can see it, but invariably then also what we saw was a case is then here you can see where the cross is that we actually also had the MACD line crossing the kind of zero line on the histogram, and price was really around about here, okay. By the time you'd be getting into it and be completing, okay, because remember you just got to wait for the candle to complete. Well, you'd be looking to be a buyer around about this kind of particular area. So with all of these trades, it's about you have to understand, and we've talked about it quite a lot on Trading Spotlight, is understanding your own risk tolerance, okay. Where do you sit on the spectrum of your of your risk tolerance? So some people would have been much happier, okay, to sort of take this trade here, even though kind of price had been sort of working its way down, which means that when price does eventually turn up, that actually their reward is greater because they enter the trade earlier, okay. Alternatively, there'll be some people who would think that trading down here, the price action hasn't shown it that it's going to turn as yet, and are happy to wait, okay, for the MACD line to cross the zero line, which means that they will be getting in later to the trade, but they feel as if they're taking on less risk, okay, because they think that the market will have played its hand, and in this case the trend is already firmly established. It is about understanding where you sit on that risk spectrum, okay. And all I can say to you is by keeping good records of your trades, it helps you to understand your risk tolerances, and also my other advice would be don't fight your risk tolerances, okay. If you are more risk averse, don't try and force yourself into sort of trading with a much more kind of, let's say, risk aggressive mindset or an attitude or trading style. It probably won't be successful for you. You need to understand your risk and then operate within that, because you'll be happier making the kind of consistent decisions you need to as a trader in your own trading decisions and endeavors. And we can see here, okay, so this is dollar CAD on the daily chart here, and we can see that the MACD is actually crossed here, okay. So you've actually got a proper confirmed signal line crossover here, which would be around about here, but actually it's price actually goes through here. The MACD line crosses the zero line here, which, as I said, would be you'd be shorting, okay. You'd be taking a short position around about this particular area on dollar CAD. So as I said, you're getting in much later than if you'd bought the signal line, okay, but what you're allowing to do is to allow the possible trend at the time to sort of flower, to develop, okay. So once again, it's where you sit on that risk spectrum in terms of your decisions. But just watching that MACD line, okay, where it is in relation to the zero line, okay, to the that can be very useful, quite a simple understanding of where you believe that the kind of the sentiment is within that market, and what kind of momentum we are likely to see in terms of the way that sort of market plays out. So, we've looked at MACD line, signal line crossovers, and we've looked at the kind of zero line crossovers. But here's the third one, okay, and this is a kind of an interesting one. This in itself is a webinar all of its own, really, okay, which is about trading divergence, okay. And for me, this is my personal favorite way to use the MACD indicator, okay. Well, some people Some people don't. Some people will be happy with just signal line crossovers or zero line crossovers. But personally, this is how I particularly like to use the MACD indicators, and in fact, most indicators is that, you know, as it says there, simply put, divergence is when the MACD and the actual price, they're not in agreement. Okay, there is a divergence between the indicator and the price. And this, okay, and this is why I'm interested in it, this is when divergence becomes a leading indicator. If you remember that, you know, all indicators are by their nature are slightly lagging because they are printing off data that comes from price. They are printing from the OHLC, the open, the high, the low, the close. They take that data from every time a candle closes, and they interpret that, and then basically plot there on their indicator. Okay, but using divergence allows you to sort of turn the MACD from a lagging indicator into a possible leading indicator. Okay, a leading indicator that allows you to make, you know, possibly some good trade decisions ahead of the curve, and we shall have a look at that here. And I'm just curious to know, people here with us today, you know, if they are aware of divergence, or if they know how to trade divergence. If you do, just pop it in the chat box. Just helps me understand, you know, where and how people are in their own trading journey. But I appreciate, as I said, divergence in itself is a webinar all of itself. Okay, understanding how to trade that. But, you know, what am I going to talk about? And today, I'm just going to talk about regular divergence. Okay, you know, as I said, it's a divergence is a whole topic that can be used, okay, in its own way. Okay, but today I'm just going to talk about regular divergence. And as I said, it's when there's a difference between the sort of the price and the indicator. Okay, so Anthony says, you know, I've used divergence, Paul, and I've also seen it on the stochastic readings. You're absolutely right, Anthony. Divergence you will see across the vast majority of indicators, oscillators. Okay, so things like RSI, MACD, stochastic, CCI, etc. You will see a divergence turn. If you can learn to read it and understand it, it provides you with an opportunity, with an idea. So what we can see here, drawing tool out as always, is, you know, hopefully you can understand and see how this is the Euro yen, and this is the monthly chart. Once again, I've tried to use different time frames and different instruments to show you that, you know, it works across all time frames. It's about just you being able to learn to read, to understand it. Okay, so, you know, we can see here that, you know, hopefully you can see that the price has actually been, you know, kind of moving down. Okay, and quite a nice downtrend there. Okay, for what is effectively for about 4 or 5 months there, it's been moved there. But what we get interested, and this is where we see the divergence, is that, you know, we can see that, you know, we're making lower lows there on the price. Okay, but actually, if you look at the lows on the indicator, we're actually making higher lows there. Okay, hopefully the little trend lines I've drawn there just help give you a bit of an indication that, okay, as price is moving down, you know, price is moving down, the indicator is basically moving up, and this is a kind of, as I said, this is when it becomes a leading indicator. This is, you know, think of this as like the it's like the kind of the you know, if you go down to the beach, okay, you can watch and see the waves, okay, coming in, right? But it's actually understanding the underlying current, the underlying tide underneath that kind of moving of the sea. All right, so think of this as, you know, when you're seeing momentum change like this, it's almost just like, you know, you're starting to see this is the time that, you know, the tide is shifting. Okay, and you know, the smart and the canny fisherman, okay, knows the effect that, you know, that the changing of the tides can have if you're a sailor or a fisherman. And it's the same with a trader. Okay, being able to read divergence and understand the underlying, you know, the underlying change in momentum within markets can be enormously useful, enormously helpful to you in your own trade decisions. So hopefully there you, and that, you know, you can see that is just what's called bullish divergence, because actually you can see even the price is going down, the momentum is going up, okay, and it's expecting to rise, and you can see what actually happens and follows from the price there itself. And here's on the opposite side, okay, and this is pound against yen on the hourly chart, and what we can see here is, you know, price makes a new high there. Okay, I've just drawn the trend line in there, but at the same time, the MACD fails to follow it. There is divergence. Okay, price makes a new high, but the actual MACD indicator doesn't. MACD fails, right? Once again, it's that underlying the divergence underlying, giving you an indication of the underlying change in momentum in that market. Okay, so that, as I said, that's when the indicator can start to be used as a leading indicator, start to give you a little bit of a hint at kind of what is coming your way. And we can see here that actually, you know, having made that high in price, well, price actually rolled over and fell away, didn't it? Fell away quite nicely, right? Fell away quite nicely, you know, even though we're making here lows, 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 but actually, hopefully there you can actually already see there's kind of bullish divergence being created there, okay, to give you an indication that, okay, that downtrend has been a superb downtrend, but that actually is probably likely coming to an end rather soon. So, and as we say there, okay, it's a case, you know, in terms of how to trade that MACD, it's we're looking at, you know, changes in momentum can precede a real significant reversal. However, nothing is perfect. Okay, you often heard me say that trading. Okay, there is no perfection. So what we look for is a confluence of events to help us make a trade decision. Okay, and that's what we look for. And, you know, I've talked about confluence of events throughout from probably, you know, the first webinar I've ever delivered here for Admiral Markets. Okay, it's about understanding a confluence of events, right? We're looking for, you know, 2 to 4 elements, okay, to come together at one particular point, all right? And that can consist of things like MACD divergence. And once you start to have that, along with things like trend line or support and resistance levels, breaks or bounces, perhaps a lower time frame moving average cross or price action patterns, okay, like bigger price action patterns or even individual candlestick patterns. Once you start to get, as I say, 2, 3, 4 of these things coming together, okay, you know, along with divergence, well, then that starts to give you the basis of a trade setup, okay, and that starts to give you the idea or the opportunity from where to actually take an engagement. And Anthony says here, you know, the difficulty I have with divergence is knowing how much of a move of a price will follow. Sometimes it can be a lot more than others. At least that's how it seems. So that's great, and I appreciate your insights there, Anthony. Okay, and you're absolutely right. Okay, you know, what we're looking for is once we have an entry, and then we're looking to see, well, actually, how long is this trade likely to play out for us? And sometimes, as I just had a look there, divergence can help you to realize when you're in a trade how actually quickly it is starting to sort of fall away. Okay, but thanks for that insight, Anthony. Thanks for your contribution. But, you know, as I said, what we're looking at here is, you know, looking for confluence events, MACD divergence, along with, you know, elements that have been covered, you know, plenty of times in the wide array of trading spotlight webinars. Okay, please feel free to go back to the archives, whether on Facebook or on YouTube or on Traders Yard, and you'll find there's plenty of webinars there on things like candlestick patterns, price action patterns, moving averages, okay, trading sort of support and resistance levels there. So there is a wealth of information there to help you with your own particular trading. Well, we're going to have a little look at, you know, at the kind of differences in setting confluence. Okay, so in this particular case here, so, you know, what we had a look at before, okay, is that not only did, you know, we had this divergence building, okay, we can see it building there, but then in terms of, well, okay, Paul, what is my particular trigger? Well, actually, what we saw here is, you know, once we'd had the underlying, you know, kind of trend line break, along which, you know, was also sort of allied with, you know, a kind of a, you know, move across the 20 period moving average, and was also kind of a bullish rejection candle as well. You know, you've had a few things happening there at the same time that allow you to sort of basically make a trade decision on when to actually to enter and to run your trade. And that's what we're just looking for. Just, you know, as I said, a confluence event, 2, 3, 4 things to come together at one time and place that allows you to make a simple trade plan that, you know, allows you to engage with markets and trade in the direction of what you hope will be the next dominant trend. And here's another. This is, you know, cable on the weekly chart. Let's just get the drawing tool up here again. So what we can see here is, you know, price has been in a very nice uptrend. Okay, you can see that yourself. There's been a supporting trend line. And then what actually happens is, you know, price here in this area, some of you may even remember this particular time, is that price ran into what we have here. This green is the this green moving average is the 200 period moving average. And what happened is price ran into that 200 period moving average, you know, and it printed on the weekly chart there, a big engulfing candle, key reversal candle. But what other traders might have noticed is that, you know, we had made, you know, a new high there, okay, from the previous high on the price action chart. But if you had been looking at the kind of MACD, okay, the MACD indicator, it failed to make a new high there, and in fact, it actually made a higher low there. So we've got, you know, hitting the resistance, dynamic resistance of the 200 period moving average, followed by a, you know, printing you know, a bearish rejection candle in the form of an engulfing candle, a key reversal. You might actually even say that that is a double top there of a sort that was formed, along with having that kind of, you know, a bearish divergence there, okay, bearish regular divergence on the chart. You know, you've, as I said, you've got three things all there coming together at one time and place, okay, that allows you to take the trade. And, you know, and once again, if your risk tolerance was, you know, was less, well, then, you know, you might have waited until actually the price crossed the 20 period move, sorry, the broken the actual trend line, or actually waited for, you know, a real clear, real sort of signal line crossover. Okay, so, you know, as I said, it's a confluence of events. That's what we're looking for. Okay, 2, 3, 4 things all come together at one time. That starts to give you a good indication that, you know, there might be a great trade setting up here, and to be ready to engage. So, and you know, just an example here, just another simple example. We can see here, this is dollar CAD on the weekly. Okay, you can see that from here, price has pushed to new highs there. Okay, pushed to new highs, but then what it did is it put in a, you know, a very simple bearish engulfing candle. And what do we also see here is that actually it failed to make a new high on our MACD indicator. So we have had there, you know, we've had price action, okay, also with divergence, and then we can see that price actually rolls over and makes a nice move down there for you know, on a weekly chart. This is for the next couple of next few months, isn't it? It's, you know, that's when it actually makes a nice move down there. Okay, so as I said, confluence of events. Okay, confluence of events, and, you know, people who wanted to sort of add additional trend lines, you might have actually drawn one in here. Okay, waiting for it to break that as well. So as I said, there's, you know, it's you know, we're providing, you know, a bit of you know, insight into the indicator, but also understanding the excuse me, the nuances about how to use it best when you pull them all together. So here we go. So that's looking at that, and yeah, the additional element of this was a case of just, here we go. It's, you know, as I said, you know, looking for you know, confluence of events in terms of what we've looked for. Some people might have wanted additional sort of ideas on how to trade that. Well, on the weekly chart, as I said, we had a case of, you know, sort of regular bearish divergence. But also, if we looked on the daily chart, if we'd gone down a time frame, well, at the same time as that was occurring on the daily chart, we also had, as you can see here, a very clear signal line crossover as well. All right, so, you know, we've got, you know, different different things coming together, confluence of events coming together. That's what gives you an indication that, you know, we have a trade opportunity. So here's the fly in the ointment, ladies and gentlemen. All right, so you've heard me talk about traditional MACD. So what we see is that the MACD on MetaTrader, okay, is different, or the sort of, let's say, the original MACD on MetaTrader is different from traditional MACD. Okay, it's created differently, uses a mixes of EMA and SMA, and it gives us a different visual representation. Does that mean that all hope is lost? Well, no, not at all, not remotely. We just learn how to understand it better, and you can actually find traditional MACD indicators out there in the on the what would you call, just on the internet, okay, and there are trading communities that would actually plug into MetaTrader. But if today you opened up a new MetaTrader platform, you'll find that most of the MACD would be as we will display it and talk about here, okay. But it's still very valuable, still very, we can use it excellently together. So, as it says there, you know, we look to adapt and overcome. So what we have here is the signal line, okay, the signal line is the same. So, you know, where we can see here, okay, on this chart, the signal line, the dotted red line, okay, here just doing its business. The signal line is the same, okay, the signal line is the same on the, you know, on the normal sort of MetaTrader MACD as opposed to traditional, okay, trad. All right, this is, as I say, please excuse my artistry. What we find now is the MACD line is now represented by the histogram. Okay, so the histogram, if we can see, if you can, you know, if you were to just draw an imaginary line, okay, along there, that is the same as the blue MACD line we see there on traditional MACD. Okay, so most importantly is that the divergence will still show using the MACD, the MT4 MACD histogram. Okay, and we'll have a look at that in a moment on some charts. Okay, that's we'll have a look at that and show you how we can see that in a moment. So hopefully, yeah, I just put up a chart here. Okay, so this is, hopefully by now you can see price makes a new high here, okay, on the 4-hour chart, dollar yen. Normally on traditional MACD, you'll see that, okay, price makes a high here, but it fails to make a new high, okay, when price makes, on the MACD, when price makes this new high. And if we're looking at the sort of standard, okay, MACD, MetaTrader 4 MACD, hopefully you can see the histogram. You can still see very clearly the actual, the divergence, okay, the bearish bullish divergence that is created. So as I said, you know, you can see, you know, there are plugins here, but what you can actually see is, you know, how you can still use it, how you can still, the histogram and the MACD on, it still gives very good representations of the of MACD itself, okay, and of divergence in particular. And just, you know, another couple of examples here in that, excuse me, price has been making lows there. As you can see, this is the Swiss yen on the weekly chart. But on traditional MACD, we can see there, you know, the price, you know, whilst price is making new lows, the MACD is making, you know, higher highs. Okay, there is divergence, but equally you can also see that on, you know, the standard MetaTrader MACD as well. So, you know, as I said, being able to see the divergence is still very, very clear, and then we basically get a break of a trend line, and you can see price rallies its way up. So it's still there for us to be able to utilize, okay, and still very valuable for us as a trading tool. So in conclusion, ladies and gentlemen, okay, you know, trading currencies with MACD allows you to identify new trends and momentum, and when used for divergence, it becomes a leading indicator. But it only works about 50% of the time, so you need a trigger, okay? And this is where we're looking for a confluence of events. So, you know, where we can use things like simple price action triggers like pin bars, engulfing candles, inside bars, key reversals, okay, where we can see where we've got trend line breaks, where you can see breaks of lines of support resistance, where you can actually see, you know, lower time frame moves, okay, things like signal line crossovers. But when we use it as divergence, well, it becomes a leading indicator, and as I say, that's my particular preferential way to actually utilize it. So if you want additional support, okay, if you want to sort of, you know, sort of debate and chat about trading more, well, then please come and join us in tradersyard.com. You can see the link there, tradersyard.com/group/312. Myself, I'll be in there for the rest of the day, and as long with my colleagues, Marcus and Jens. And don't forget, you can join us for the next webinar where my colleague Marcus will be talking about a beginner's guide to CFD trading, talking about what a CFD is, what are the benefits of trading CFDs, and an overview of the concepts beginners need to understand. And he'll be doing that 2 o'clock London time, Wednesday, 6th of May, which will be in your inbox. You can always find lots of analysis and education on admiralmarkets.com, and you can contact us, email hello@admiralmarkets.com, or youtube.com/admiralmarkets, or facebook.com/admiralmarketsglobal, where you'll be able to see the recordings of this video and all the rest of the Trading Spotlight series. So we've got about 2 minutes left. So I hope you found that useful. I'm going to quickly just have a look at euro dollar, what's setting up at the moment, just for the last moment or two, just to have a little bit of look. But there you go. Robert says I was going to ask about that. Why there was only one line on the MACD. Now I know. Thanks. You're very welcome, Robert. That's what we're here for. But as I said, we've got a minute or two. I'll just have a quick look at the live charts, okay, just to have a look on euro dollar to see what we have there. So if you just bear with us just to finish up, okay, I appreciate it. Always helps for us to have a little look at live charts. Hopefully you can see there, okay. So I've just drawn up here, okay, as let's just move my stuff around so it's a bit easier for me to draw. So here is euro dollar on the hourly chart, okay, and we can see today that what happened is, or kind of this is coming in from from Friday, is that we can see price, had a real rally up there, strong rally up, and made itself a new high. But ladies and gentlemen, if we look at the MACD, okay, and the histogram there, clearly, okay, it failed to make a new high there, okay, didn't it? We had basically divergence. We had regular bearish divergence. And, and if you start to look, we can see that, there was a supporting trend line there, okay, and when that broke, that gave you an opportunity, okay, to actually sort of take a short trade there, just based upon the bearish regular divergence you've seen there happening. So unfortunately, we've run out a little bit of time. I tried to squeeze as much as we can into our session, ladies and gentlemen. But hopefully, hopefully you found that useful in terms of understanding the various ways that MACD can actually be used, how you can actually use MACD with divergence, and actually once you understand divergence, even just understanding simple regular divergence, and once you allied that with other elements for a confluence of events, things like trend line breaks, price actions, okay, patterns, candlestick patterns, then you start to have the ability to put together a very simple, very robust trading plan that you can utilize across all time frames and across all instruments. As always, I wish you the very best of success in your own trading, ladies and gentlemen. Stay safe, stay well, and I'll look forward to speaking to you soon on the next Trading Spotlight webinar. Many thanks. Trade well, everybody.